Again, the laws and auditors, what auditors do, so let me explain. Most people think about auditing like like they have some kind of legal authority. But auditors are really just making sure you're following the rules and you're doing things the way they're supposed to be done. They don't really have any legal authority. If you're breaking the law and an auditor finds out that you're breaking the law in Oklahoma, you either go to the OSBI, Oklahoma State Bureau of Investigation, or at the federal level, you go to the FBI, and or you go to the county district attorney's office and you file charges. So an auditor is not a police officer, so to speak. They're not a law enforcement person. But if they find wrongdoing, then their duty is to go to one of these law enforcement agencies. And then believe me, you do not want them in your office. And especially if it's triggered by the state auditor's office, because the state, they do have things that they can do. Like I said, they can literally shut your business down until they get their money if you haven't paid them. Now, that's normally not something that's going to bring criminal charges. Criminal charges go, like I said, through the district attorney or the OSBI. So this week we're talking about cash, fraud, and internal control. And what happens is auditors come in and they go, a lot of people who get a bachelor's degree in accounting, that's where they start. To get some experience under their belt, they'll go to work for an auditing firm. So remember, there's the government auditors, like you think of the state auditor or the federal IRS auditors, and they work for the government. But then there's private auditors, because by law, the publicly traded companies have to hire outside auditors to come in and audit their work. And these auditing firms, that's what they do. There's also internal auditors. My first job in accounting was an internal auditor. And why do you have an internal auditor? Because you don't want the external auditors to catch it, right? Because you don't want anything on your record. It goes into your permanent financial records if you've violated some kind of thing or you've done something wrong. And remember, if you're a publicly traded company, then that affects your investors. If they think, hey, something's shady going on here, we're not going to invest in this company. And so smart companies, big smart companies hire internal auditors to check everything, to put procedures in place, and to do all the stuff like we're talking about in this particular chapter to prevent the outside auditors from finding something. And so some government agencies, like when I worked for Tulsa County, you have multiple auditors. You have internal auditor, you have external auditors, which is the state of Oklahoma, and then you have the hired private auditing firms. And so you're doing it all around to try to keep yourself out of trouble, because you don't want any trouble, believe me. Every state is a little different too on the state. California is horrible. They will literally come in. If you had a small retail shop, believe it or not, if you have a small retail store and you're selling stuff and you're not paying your sales tax, when you sell something, you collect sales tax, and then you're supposed to turn that sales tax immediately, of course, monthly or quarterly. In California, it's quarterly. In Oklahoma, it's monthly, I think. You turn it over to the state. And if you don't, in a sense, you're stealing from the state. And I was going to say this, in California, they can walk into your business and they'll say, hey, we're going to stand here. And when people come in and give you money for whatever they're buying, guess what? We're taking it. It's not going in your register, your bank account. It's going to us. So they can, also the IRS, again, with the taxes, you can't get away from them. If you have problems with the IRS, they will find you. You can change your name. You can become, what do you call that? Hidden identity. But anywhere you ever go to get a job or use your social security number, they're going to find you, and they will garnish your wages. So anyway, that's just kind of my speech on don't do criminal things. But there's a lot of things that you have this idea that, well, it's not really criminal, but there's a disagreement. Like maybe I think that this is okay, but some other accountant says, no, you can't do that because that's going to show this or that. And so there are disagreements, not necessarily criminal things, but the right way to do things and the wrong way to do things. So this chapter for us, because it's again, introductory chapter to these kind of concepts, it's just kind of going to give you some things that are put in place. So it talks about internal control. So we said you have an internal auditor sometimes, but what they're going to do is, what do we do within our company to control? In this particular this particular chapter is talking about cash. So and money, of course, real money, right? So we talked last week about inventory. And so if you're managing the protection of your assets, what is your assets? Now, obviously you have fixed assets, which we'll talk about in a future chapter. Those are your equipment, your vehicles, major pieces of equipment that's going to last for more than 1 year. You have to protect that from getting stolen. If you are a retailer in particular, and a lot of your money is tied up in inventory. In most cases, your cash is in cash or it's in some kind of other asset. In many cases, it's in fixed assets if you're a company that's heavy into fixed assets, or you could be a company that is retail or merchandising where your money is tied up in inventory. So the last chapter we talked about, how do we protect our inventory? How do we make sure our inventory is right? How do we keep people from stealing on inventory? This chapter is about how do I protect my cash? Because believe it or not, obviously, think, well, anytime that people are handling cash or they have a opportunity to steal, they might. And we'll look at that here in a minute. Okay, so we're going to talk about internal control. What we're trying to do is, what that means is inside the organization, we're trying to do things to control people from stealing from us and internally, right? So here's internal controls include protecting our assets, which I just said, ensuring reliable accounting. Nobody's doing anything goofy on the accounting records. Uphold the company policies. Company policies are put in place many times for internal control purposes. Promote efficient operations. So auditors, so an auditor will come in, especially if they're an outside hired auditor, they're going to come in, they're going to look at your procedures, they're going to look at your policies, they're going to try to see, are people following the policy? Do you keep track of your assets? And they're going to give you recommendations. They're going to say, well, we didn't think that you did anything wrong, but here's a place where you could improve, right? And that's what this is, promote efficient operations. You could be more efficient if you did things this way, okay? And remember, efficiency is, we think of from a manufacturing, or how do we make things quicker or more efficiently, or manage people efficiently. But this is talking about how do we promote efficient operations in our accounting and our cash management, right? So the first thing we have to talk about, and we have in the past, I believe, mentioned the Sarbanes-Oxley Act. I didn't show you the video on that. I'm going to show it to you. 2002.
In late 2001, people began to notice some accounting irregularities with a large publicly traded company. The company had a national reputation for consistency in both good times and bad, so it was considered a blue-chip stock. The name of this company was Enron. Within weeks, the stock went from over $90 a share to being nearly worthless. This occurred because the management team tried to cover up losses from the previous years by altering their financial statements. The deception that occurred gave the public a reality check, and in effect, investors started taking a look into the financial records of other large corporations. Sarbanes-Oxley Act was introduced into Congress by U.S. Senator Paul Sarbanes of Maryland and U.S. Representative Michael Oxley of Ohio. Their intention was to create a law which would restore the faith of investors back into corporate America. By imposing stricter standards on financial reporting, there would be an increase in the reliability of the financial statements created by any given company. Let's take a deeper look at what the Sarbanes-Oxley Act includes. First, officers of the company are required to sign financial statements for accuracy. This holds them personally accountable for any misrepresented data. Second, an increased fine and/or prison sentence was set for individuals who attempt to defraud investors or misrepresent actual figures. Third, the company must provide a description of its internal controls. This is an attempt to increase the confidence of the public in that organization, while allowing them to gain an insight into the company's procedures. Fourth, the company is responsible for hiring an independent accounting firm to come in and audit the accuracy of their financial reports. The financial reports are now required to have a section dedicated to the auditor's opinion as to the accuracy of the figures presented in the reports. Fifth, the company is now mandated to report all off-balance sheet transactions on their reports. Finally, the Securities and Exchange Commission is given more power to look into companies that are suspected of wrongdoing. The SEC will now do random reviews of companies to ensure that they are complying with the Sarbanes-Oxley Act. Their reports are then published and released to the public for viewing. The SEC has a special division that is designated to work with Sarbanes-Oxley issues. This division is called the Public Company Accounting Oversight Board.
Let's go on here. So here's principles of internal control. And we mentioned some of them already. Common to all companies, it says. Now, again, if you're a publicly traded company, you have a little bit of a higher standard by the Sarbanes-Oxley Act. But even if you're running your own company, you know, it's your duty to protect your cash and what's happening in your company on the financial side, right? So you would want to do these things. Establish responsibilities. That means, and we'll get into depth in that a little bit more too, but it's about, you know, this is your job and this is what you're supposed to be doing. Maintain adequate records, of course. Ensure asset and bond, insure, that means I'm going to buy insurance on my assets. If I have $1 million, you know, piece of equipment, I'm going to insure it in case it gets, well, it probably might not get stolen unless it's something small, but you know, you're going to insure things. The cruise lines have billion-dollar cruise ships, and when the cruise ship got pushed up on the rocks a few years back and killed a bunch of people, and the ship fell over, and it was a relatively brand new ship at that time, you know, I always ask my students, what were they concerned about? And everybody says, man, they had $1 billion fixed asset that was destroyed. And I says, well, but the ship was insured. You insure your car, so why wouldn't you insure $1 billion cruise ship? What the company was really concerned about was future revenues, because they had, you know, like you learn, and specifically in your managerial accounting, you plan, if I'm going to buy an asset, what is going to be my return on that asset? If I buy $1 billion cruise ship, I expect it's going to be generating money. And so if it's destroyed, then I don't generate that money. Okay, bond key employees. Bond, that means taking out an insurance policy on employees. In fact, I think they go through each one of these here. So let's just go on. Yeah, establish responsibilities. Tasks should be assigned to one person. And I'm going to tell you about a story here in a minute. When we get through these, a personal story that I experienced in my previous employer. But we have multiple people. Imagine you have an office with several office people there, and somebody is coming in, giving you money, giving you cash, paying for something. Now, we're not talking about retail where you're buying something, but maybe I'm paying, in our case, it was a permit. You were going into the government building to pull a building permit. And most of the times these are contractors. Contractors operate in cash. There's a lot of cash money. So, they don't have a checkbook, and they're not paying by credit card because a lot of the money they collect from their clients is cash. But what this is saying is, in this office, you have multiple people collecting cash, but all the cash eventually belongs to the company, right? It should all wind up in the same place. But if I have multiple people collecting cash in a situation like that, and then money gets missing, well, then you get into the he said, she said kind of deal. Who stole the money? Well, and I'll tell you about that in a minute. Can you determine who's at fault? Of course not, right? Maintain accurate records, protect assets, keep managers monitoring company activities. So helps managers monitor. Now, this is a bunch of things. Chart of accounts, we talked about that early on in the class, how important your chart of account is. Pre-numbered sales slips. Everything is computerized nowadays, and computers are designed. When they're designed by auditors, right? Now, computer people can program it, but the programmers don't know what to program. If I'm a programmer and somebody says, well, build me a program that's going to do this, well, I need to understand, I need to know what it is that you want it to do. So the people that set these software programs up are the ones that's telling the programmers how to set them up. But this is one of the things that you do is you put pre-numbered sales slips. In other words, you can't use the same number over and over. And we had a system, another system I had at one time where every time you do an invoice, because it's talking about, maybe a receipt or an invoice. So it means the customer gave me cash, they get a receipt, just like you do when you go to the store. Well, every receipt should have a different number on it. So we can always trace who was the person that was working that register at the time that this receipt was given, right? Or assigned to that particular register where you were working. I had a company that I worked with that their numbers would be a different number every time. But at the end of the fiscal year, when you'd close out your year, like we talked about in chapter 2, I think, 3, where we close the year out, the closing process in the software started the numbers over again. So you'd have 2019 numbers, and then you have 2020 numbers. And every year you could repeat the number for each year. And they didn't think that was going to be a problem. Well, it was a problem because you don't think about it when you're doing it the first year, but by the time you get 3 or 4 years into the future, and now you try to pull up a particular receipt or an invoice, you would have one for every single year. Computerized point of sale system, POS, point of sale systems, and we've talked about that again in the past. That's where you go to Walmart or wherever you shop, and they're scanning it through the system, right? Remember we said last time we were talking about inventory. We buy the shampoo from Procter & Gamble. We scan it through the back door coming in, and then it goes through on the shelf, and then it goes through the front door, through the register, and it's kept track of protecting your physical inventory assets, like we talked in the last chapter. But the point of sale system is also keeping track of those receipts. It's keeping track of who's working the register. It's keeping track of the money. And have you ever, we've all probably been to stores where they've made mistakes. This is what I was just talking about earlier. Okay, insure the assets, bond key employees. So bonded means the company's purchased an insurance policy on that person. Now, again, certain jobs, like if you work in a bank or you work with money, many times you'll even see on the job application, if they're hiring somebody, must be bondable. In other words, we need to be able to insure you. Obviously, if you have enough money, you can insure even the felons that just got out of prison for embezzlement. But in general, this means that you got to have a pretty clean record. The company's not going to hire somebody to handle money that's got a track record. So bonding. I was going to say now all of your jobs that are higher level jobs, working with money. I was bonded when I worked at the county as chief financial officer. Our treasurer was bonded. Our accountant that was over the financial records was bonded. So that's just part of the job. Person who controls. Okay, separate record keeping. Now, this is another one that's kind of a biggie that the auditors look at. The person who controls or has access to assets. Now, this wording should say physical assets. Physical assets. So the person who has the physical asset must not have access to the asset's accounting records. Okay, so if I have access to the accounting records and I have access to the actual physical thing, I could take the physical thing home with me and then I could change the accounting records. Does that make sense? I'll tell you where this is a big one. I don't know, I'll tell you all these personal stories. The records room. This was a huge problem. The records room at the jail was actually in the sheriff's office. So when somebody goes to court, let's just say you're a police officer and you do a drug bust and you find a big duffel bag full of cash in the trunk of the car that you just pulled over, and then these people get arrested and they're off to jail and you've impounded the car, but you got a big bag of cash. And part of this big bag of cash is a court evidence that we're going to introduce in court that says this person wasn't just, buying marijuana or heroin or whatever for their own use. They are out there selling it. They're dealing drugs. Because they've got so much money. Now, what do you do with that money? Where do you think that money goes? Now, remember, I'm not talking about long-term. I'm talking about the court as it's going through court, right? They've done their forensics. They've had the people with the fingerprints and all the stuff that they do like that. That goes to what they call the evidence room, okay? And the evidence room, they hold all this stuff. And I mean, it's got, bloody knives and, clothing that's been stabbed or shot through, but it's, everything that's evidence in court stays there while this person's in jail for the court. And most of you know, if you don't know, if you go to court, it's not like, oh, they picked me up today and tomorrow I'm going to court. It's like they picked me up today and 6 months or a year or maybe 2 years, we're going to go to court. Court proceedings, and the more complicated it is, the longer it takes, right? But even just a normal thing takes months, if not years now, especially with being shut down with COVID and all this stuff. Where I'm going with that is, if there's $100,000 in cash in the evidence room, you can say you're really an honest person, but at some point there's a dollar amount that people who would ordinarily be honest become dishonest. And there was a big problem we were talking about. I mean, we went through this big argument about it. How come we're keeping 100,000? And the sheriff's office at the time, which was right, they wanted to take it and put it in the bank because it had been through all the forensics and all these things. They said, we want to get it out of here. We don't want it sitting around in our back room. Now, I don't know what it is today because, that was years ago. But there was a law in the state of Oklahoma that, and again, this is all legal stuff, but the law said that police and law enforcement agencies could not earn interest on money that was seized through drug busts and these kinds of things. And the reason for that law was because if I pull you over and you got $50 in your pocket, I could take the $50 as evidence for whatever, even if, you know, I thought you were stealing something or whatever. And then the sheriff or the police department could have built up, you know, piles and piles of cash in the bank and be making interest on all this money that really didn't belong to them, right? Until it went through the court system. And so the law was there to prevent the law enforcement people from taking money from people for no reason. So in other words, if I take your money, your big bag of $100,000 and it goes in the back room, is a lot different than if I take it and put it in the bank and then I earn interest off of it, because I want to keep it in that room in the bank as long as I can, because I'm getting free interest on the drug money or whatever. Now, again, after it goes through the court system and everything's settled, then there's another whole process, what happens to it. But I'm talking about for the months or years that it sits in the evidence room. This was a situation where you have one person in charge of the evidence room, but the person that was in charge of keeping track of the inventory and all that might be a different person. Because if I had access to $100,000 in cash and I had the ability to change the records, I might be tempted. No, I'm just joking. I wouldn't be, because I won't bore you with another story I have about where I was given I had worked at a job in California in finance, and I'd worked there for 2 weeks. 2 weeks I'd worked there, and they gave me the the safe, the combination to the safe where they kept all of and it wasn't money in there, it was checks, signed checks. Okay, reduce risk of theft or waste of an asset. Employees would need now. So this is talking about exactly what I was talking about. Collude. People would need to collude in agreement. You know, if you were in control of the financial records, and I was in control of I was the guy that worked in the evidence room, which is really not a very good job, by the way, because some of those clothing that's in there are soiled, because when you get tased or pepper sprayed, things might happen to your body that cause it to not be nice when they're sitting in there for 6 months. So anyway, we might collude, right? All right, so let's go on. Divide responsibility for related transactions. Now, this is the one where related transactions, one of the ones that the auditors would always write us up for was because we might have an office with one person, right? Now, if we have one person and you have one person sending out bills, so follow this. I'm the person that's doing the billing. And this is true for most small companies. You got one person doing everything. I'm sending out the bills, but when the money comes in the envelope, I'm also the one that's opening the envelope and taking the cash out or the checks out, right? So again, they want what they call separation of duties, meaning that I have one person that does billing and one person that takes the money in and clears off the accounts receivable and deposits the money. Two different people. They don't want the person with the bill, doing the bill, to have control over collecting the money, because I could get the money. Imagine the situation like I talked about. Oh, we got a bill for this contractor because he pulled the permit. It was $500, which there weren't that much, a couple $100 at the most. And at the county, at city, different. So the guy comes in, he gives me $500 in cash, and I send him a bill, then I could go into the accounting system. Now you could, in our accounting system, you couldn't just delete a bill, but you could revise the bill, right? You could say, oh, well, there was a mistake, or maybe he pulled, all these permits that was, we charged him $500. And then when he came in, it was turned out that it was only supposed to be $150. I can change the bill and pocket the money. Okay, technological controls. That's kind of what we were talking about with the software. Now, this goes back to the one I was talking about. In fact, I think these two are together. Apply registers, make the file, time clocks, when are the employee on the shift, you know, who's checking out those cash drawers if you work in a place where you're like collecting money. Auditor, preferably done by auditors not directly involved in the activities. Okay, so technology, that means, like I had said earlier, the auditor is the one that's designing these technology controls because they're trained. In auditing, you get trained on how do we prevent any of this stuff from happening. Is it going to happen? Yeah, it's going to happen because that's just the way it is. There's always somebody, and I could tell you story after story of things I've seen. Of people getting around the system. But the technology, so here's what happened. We have the two people working in the office taking this money from the building permit people. The contractors are coming in, you know, maybe all day long giving cash. Sometimes I'm on break and this other, and it's not me, it was people. So one person's on break and the other person's getting the money at the counter. And then this person goes on break and the other person goes to the counter and gets money. So they're all collecting money. And the people didn't get along in the office. And so what happened is one person was always trying to get the other person in trouble. And they had this idea that, well, if I accuse that person of stealing, then that person can get fired because they were caught stealing the money that was coming in. And so this person said, it was after it went to the place where it was being deposited. So I went to the, not me again, this person went to the, where all the money was collected at the end of the day and says, oh, we're supposed to have $4,000. And I'm making it up, you know, I'm supposed to have $4,000, but I only have $3,500. There's $500 missing. You know, and so it was so-and-so because, you know, I log everything on mine and they log everything on theirs. So it was their person that sold the $500. And she went through the whole process to try to get her coworker fired for stealing money. Well, what they didn't know is the software keeps track, even though you may not be aware of it, the software is keeping track of who it is that is accepting the money. And it turns out that when we pulled all the records that's in the back end of the software, it said that this money, this $500, and I don't know if it was 500, but you know, what was missing was actually under the person's name that said that the other person, that was the person who was doing the accusing, that was missing the $500. But because it all went into the same pot at the end, they didn't really know that the software actually kept track of every time you touched it, it logged it on you, and anytime the other person touched it, it knew it was them. And it was built into our software. Now, the end of the story wasn't really very good. They both wound up getting fired. But anyway, because they both, nobody could wanted to, that's another story. The real world is not always like you learn in textbooks. So apply technology controls. Technology fraud, this is a little bit more of the same thing. This is reducing errors, separation duties, increased e-commerce. Now, this is one of the things that you'll see in this chapter. It still keeps saying, you know, make sure you're not collecting cash. Only take money orders and credit cards and cash, which most people are moving all to that debit card and credit card anyway. But, you know, they still have places where people mail a check in, even though you could have your electric or water bill taken out of your bank account. Some people, especially older people that are more cautious with their money, I guess you might say. So what is the limitations of internal control? So there is human error. People make mistakes. carelessness, misjudgment, confusion, a lot of things. This could be a mile-long list. But really, sometimes things happen that make it look like you stole money when you really didn't, right? You know, if you've ever worked in any kind of retail place where you're taking money all day long from customers, you know, it might be really easy to give a person a $5 bill back instead of a $1 or something like that, you know, where you just made a mistake. It wasn't necessarily that you were trying to steal any money, that kind of thing. So this is you know, how do you separate this? And what you typically do is you set a policy that has a margin of error. In other words, if I'm working a cash drawer at Target or something, and maybe some of you have done this and could tell me more what their policy is, but typically they're going to have a policy that says, well, if you're a cash drawer, if you start with $200, at the end of your shift, you could be off by $20, you know, like 10% or something. And if you're off more than that, then you're either going to get written up or you're going to have to come up with the extra money yourself. I know that one of those that's really big on that is waitresses. If you've been a waiter or waitress, sometimes they have a lot of, because they're collecting cash and they're taking people's credit cards and stuff right at the table a lot of times. So there's a lot of that kind of stuff that goes on. Anyway, the point is if I have this margin of error and I find that one employee is always outside that margin of error, you know, they got written up once or twice or 3 times, they're gone. But if a person knows that if you go over a certain percentage difference, then, you know, they're going to have to pay for it out of their own pocket, then they're less likely to steal. Okay, human, and they might be more careless, even if they're not as careless, even if they're not you know, intentionally. This is human fraud, intentionally defeating internal controls for personal gain. And people do this all the time. Like I said, I could tell you all kinds of stories. In fact, one of the best ones, though, is I told you my first job in accounting was an internal auditor. And, you know, I was just doing accounts receivable and accounts payable auditing. And we had certain standards that we would follow. And so certain bills that you were paying as accounts payable clerk, you audit heavily, and others you didn't audit as heavily. Okay, in other words, in our case, let's say it was an employee reimbursement and you were an employee and you went on a business trip and you went to, you know, how shall I say it? Where did you go to eat? You went somewhere like, I don't know, P.F. Chang's or you went to some expensive place to eat and you ordered drinks and, you know, you're got a whole bunch of people you're paying for stuff. Then we're going to audit that really closely because, again, in our policy, it might say that, you know, well, you could buy food, but you can't buy alcohol. That's the way it was with the government. But, you know, so you would audit those real carefully. Other things, you know, supplies and things that we were supposed to get from vendors, we would audit very closely to make sure that the vendor wasn't overpaying us. However, some of the things that we didn't audit very much, we just looked and made sure everything looked good and pushed it through, was utility bills. So we paid a lot of utility bills. We had a social services department. This was in California, not Oklahoma. And they paid, you know, utility bills for low-income people or for elderly people. And what would happen is they didn't even want you to see who it was because they didn't want, you know, it was private information that this person was on public assistance. So we were auditing these bills. We never paid any attention to it. You know, we just said, oh, here's another electric bill for somebody. So where I was going with this whole story is we were just clerks, but the boss, we had a supervisor. Supervisor was over like maybe 20 people. And she had the final say so. So anytime we found something that was questionable, we would go over to the boss and say, hey, what's the deal with this? And they'd say yes or no, or I'll look into it. But here's what happened. The boss decided, well, nobody audits utility bills, so I'll put my own utility bills in to be paid. So she put in her own electric, water, gas, and that's how it started. It started where, okay, here's just another electric bill for somebody. Nobody paid any attention to it. It was hers, the boss. And then so then, people get greedy. And that's what we're going to talk about here. The fraud triangle, which isn't in your book, but I put this in here because this is something I always talk about when we get to this. It says opportunity, pressure, rationalization. That's in your book, but this is what we call the fraud triangle. But here's what happens. So the person gets they get their electric bill paid for, and then they realize, well, the company has a tuition reimbursement plan for people's college. And so I'll just put some of those through. And even though I'm not going to college, they'll just pay it, and so they'll give me money like as if I was going to college. And then she started putting through her house payment. I mean, it got to be crazy, all the things she was putting through. And she did this for a long time, because what would happen is let's say I got the college reimbursement, which would be one that we would audit, because we're paying an employee's tuition or something. And I'd say, oh, this looks kind of, I have a question about this. You take it to the boss and they'd say, okay, no problem. I'll take care of it. I'll call the department, because most of the time we were an internal audit department. And these were departments that we never even saw the people. They were in other locations, that we didn't even know who these people were most of the time. So, because you're just looking at the financial records. Oh yeah, don't worry about it. I'll call the guy over there, the director, and see what's going on with this. Well, it was all her bills. So anyway, so what the fraud triangle is, and this is really, you can see this different ways. I like to personally, I think this is a good one. I picked this one off of YouTube or not YouTube, but Google, because this is the one I like. It puts pressure right up here at the top. We all, well, I don't say we all, maybe some of you are independently wealthy, your parents are rich, or grandma and grandpa left you millions of dollars when they died or something, I don't know. But, if you're, most Americans, at some point in your life, you'll have some kind of financial, look at this, financial or emotional pressure. And again, it doesn't matter how rich you are. Michael Jackson, remember I don't know if you know Michael Jackson. Michael Jackson, the guy was making $250 million a quarter from his music holdings. Okay, not from him doing tours or anything else or t-shirts with his picture on it, but just from the music portfolio that he owned, he was making $250 million a quarter. That's like $1 billion a year. Now, of course, there's expenses, so he wasn't netting $1 billion a year. But to get the picture, and the guy was still broke. He was not paying his bills. He was going out shopping, like buying crazy stuff. But the point is you don't have to be poor to have financial pressure. Some of the most wealthy people are the ones, and if you watch American Greed, by the way, watch American Greed. That's another great show. It's on MSNBC Business or something. American Greed. It talks all about these people. Some of them are they're just criminals, but they're, a lot of people, it starts off with pressure. Imagine, what you find here in Oklahoma, according to the state auditor's office, is, the little old lady at the school lunch counter at your high school is down on the weekends playing bingo at the Indian casino. And then all of a sudden the Indian casino decides, oh, it's legal now. We're going to bring in 10 million slot machines. And she's like, well, I'm going to start playing slot machines as long as I've been down here playing bingo all these years. And so next thing you know, she's got some problems. She's taking her whole paycheck and her Social Security check, and Grandpa needs some prescriptions. And she's like, oh my gosh, how am I going to get Grandpa's prescriptions and pay the doctor bills? And then thanks thing you know, and by the way, it's a true story, took the money out of the till at the school lunch counter. And so the kid comes in, the ones that have to pay come in, and the parents are paying, say, we're going to pay a month in advance for Susie to get her lunch. And they keep saying, well, Susie, she's drinking that extra milk today and she got the extra banana. So, you know, it's not just $2, it's going to be $4 a day. So parents are putting in more money for Susie, and Susie's not getting any fatter, even though according to the lunch lady, she's eating twice as much. I know I'm going on, but the true story, true story. So the little old lady from the lunch counter now is the criminal because she was under financial pressure. And what did she do? She had the opportunity. So this is the fraud triangle. I have the opportunity because I work at the lunch counter, and I'm not stealing it because I'm an honest, you know, I go to church every Sunday, sing in the choir. I'm going to pay it back as soon as I hit the big one, because I'm bound to hit that big one on that slot machine pretty soon. And that's the rationalization, personal justification. I've got to pay grandpa's prescriptions to keep him alive and the doctor bills. And I got pressure, and my opportunity is, hey, I'll take, you know, some extra money out of the till at the school lunch counter, and then I'll pay it back when I hit the big one. And this really has happened many times. So people look, you don't even look for the opportunity sometimes until you get into these situations. We had an IT guy, and I know maybe I told you these stories, you know, the IT guy, the guy that fixes your computer. You're in a big company. You got buildings all over the place, right? I got a building over here, a building over there, but you got one IT department that services all the buildings. So the IT guy, what do? He's always carrying out a computer. Oh, your computer's broke, I'm going to replace it. He's carrying out a computer. So every time you see the computer guy, in fact, he's got a cart. He's got a whole cart full of computers and, you know, computer stuff, monitors. He's like, and nobody thinks anything of the computer guy with the cart full of monitors, right? Because that's his job. He's changing them out. In reality, he's taking them home, putting them on eBay. True story. Saw that one too. The guy was stealing the computers from the company. He'd replace computers that were nothing wrong with them, order a new computer, go in, oh, I need to replace your computer, it's time to replace it. Nobody thought anything, he's hauling them out. And then how they caught him was he was selling them on eBay. Somebody noticed that, hey, this is Charlie, that I don't know what his name was. Charlie we work with, he's got an eBay business here. I went on to look for something, and there's Charlie with 10 million computers, and they look exactly like the ones that we down at where we work. They caught him. He went to jail. Then, by the way, the lady with the auditing, they found out that over a period of time she'd sold, and now this may not be a whole lot of money, but when you're talking about ordinary people's income, I think it was close to $100,000. So, you know, and this is years ago, $100,000 for a normal person to steal over a couple, you know, a year maybe, it's a lot of money. It's not like millions like you hear about on American Greed, but, you know, that person got away with it, by the way. They got away with it for years. Well, not years, but actually what happened was they didn't even catch it that she was doing that until she found out that she was probably going to get caught. So she quit and she left. So now the person's gone. And even though you're going to go after them and prosecute them, then it's the whole process in court and all that business. And 9 out of 10 times you don't get any money back. Handling cash. Okay, let's see what I want to do here. Oh, EFT. Now your book doesn't have EFT here. I printed it in here. Anywhere where it says check, I have to put EFT. EFT stands for electronic funds transfer. This is what most people use to pay their bills nowadays. It comes right out of my bank account. I get paid, you know, whatever, the 1st of the month. And then on the 5th of the month, my electric goes out, my gas and all those bills. And that's electronic funds transfer. Now, we're going more and more in this to the world we live in. And that's a good thing for companies, right? Because we can control it. It's much harder. I can't steal electronic funds transfer unless I have it go into my bank account, which I've seen that too, by the way. Open up a bank account in my name. Let's see, how did that work? They had the routing number and they said this is, I forgot how it worked exactly right now, but anyway, a person opened up a bank account. I told you the one where the person had taxes, right? The CPA lady, to pay the taxes was her bank account name. She went and filed a fictitious business name called To Pay Your Taxes. And then she opened a bank account in the name of To Pay Your Taxes. And she was doing bookkeeping and accounting for big companies that have lots of money, and small, privately owned. Okay, when I say big companies, I'm talking about big companies that generate a lot of money, but maybe owned by a family or an individual, because there's a lot of people that have good businesses, right? And so what she would do is she'd just have the owner sign the checks that say to pay the taxes. So here's your checks you got to sign for the month. This one goes to pay the supplier. This one goes for your rent. Oh, and this one's to pay your taxes. And she would take all the checks that was made out to pay your taxes, and that was her bank account. Cash equivalents, liquidity. Now here's one of the things we're going to talk about, which you hear a lot in accounting, which can be confusing, is cash, which says, obviously we know what cash is, right? Deposit in the bank account. Money in the bank is considered cash, even though it's really not cash. I got a video I show on that. I don't know if we'll get to it in this class, but it's a great one. What happens to your money when you put it in the bank? It's not in the bank. Also includes items such as checks, cashier's checks, certified checks, and money orders. This is what we all consider to be liquid cash. Where's my other one? Oh, this is cash equivalents. So cash equivalents, this is the one that kind of confuses people. Short-term, highly liquid investments. This means if I have it's something that I can convert to cash really quickly. It's not accounts receivable. It's not inventory. It could be things like I have a CD, like a CD is a certificate of deposit. A lot of times, and especially right now, interest rates are really low, but and who knows what's going to happen in the next several years. If inflation takes off, interest rates will go up, and then people that have cash are going to be wanting to put their cash into bank accounts that earn more money. And there will be some of them out there if we get inflation. And so a lot of times the bank says the longer we can keep your money, the more interest we're going to pay you. So we'll pay you 1% if you put it in your checking account where you can get it out anytime you want it, but we'll pay you 3% if you put it in a 6-month or a year or even 5-year certificate deposit. That means you're going to give me your money for 5 years and I'm going to use it. I'm the bank. For 5 years, you're not going to touch it. And I'm going to pay you more interest for that right. Now, at the end of that period, because what happens is banks take these and they have them come and due every month, because maybe yours is 5 years, but there was somebody else that did it 5 years ago. And every month they're coming up, right? So the ones that are coming up, even though they're actually technically a locked in type thing, that's something they can convert. If I had a CD and I knew that I could withdraw it next month, then that would be liquid. It's real cash money. Okay. Convertible to known cash amount, not sensitive to changes. That's the problem that you have with inventory and accounts receivable and other assets, is you can't control what their face value is, where if it's money, it's whatever it's worth.